Hello students of commerce and finance. Today we explore a vital topic: accounting standards. Think of accounting standards as the official rulebook for preparing financial statements. These are not just suggestions, they are mandatory guidelines. Companies all over the world use these rules. This ensures that their financial reports are made in a similar way. This is very important for everyone who reads these reports. It helps them understand the true financial health of a business. These standards are the foundation of trustworthy financial information. Learning about them is key to your studies. Accounting standards are essentially a set of principles and procedures. These principles dictate how financial transactions should be recorded. They also specify how these transactions should be reported. The main goal is to make financial statements consistent. They also aim for comparability between different companies. Imagine trying to compare two companies if they used completely different rules for their accounts. It would be very confusing and almost impossible to make good judgments. Standards bring order to this process. They provide a common language for financial reporting. Now let's delve deeper into why accounting standards are so crucial. One of the biggest reasons is comparability. Imagine you are an investor. You want to invest in either company A or company B. If both companies follow the same accounting standards, their financial statements are comparable. You can look at their profits, assets, and liabilities, then you can make a fair comparison. This helps you decide which company is a better investment. Without standards, company A might look more profitable just because it uses different accounting tricks. Standards prevent this. Another key reason is consistency. Accounting standards ensure that a company applies the same accounting methods year after year. This is called consistency. Why is this important? It allows users to track the company's performance over time. You can see if the company is genuinely growing or improving. If a company kept changing its accounting methods, its financial results would not be reliable. It would be hard to spot real trends. Accounting standards cover several key areas. Two of the most important are recognition and measurement. Let's start with recognition. Recognition in accounting means deciding when an item should be recorded in the financial statements. It's about timing. For example, when should a company record a sale as revenue? Is it when the order is received? Or when the goods are delivered? Or when the payment is received? Accounting standards provide clear criteria for this. These criteria help ensure that items are recorded in the correct accounting period. Next, let's talk about measurement. Once an item is recognized, the next question is, at what value should it be recorded? This is where measurement comes in. Measurement is the process of determining the monetary amounts at which elements of the financial statements are to be recognized and carried. Beyond recognition and measurement, accounting standards also guide presentation and disclosure. Presentation refers to how financial information is organized and shown in the financial statements. Think of it as the layout and structure of the reports. For example, standards dictate the format of the balance sheet. They specify how assets, liabilities, and equity should be classified and presented. Assets are often split into current assets, which are short-term, and non-current assets, which are long-term. This helps users quickly understand the company's financial structure. Similarly, the income statement or profit and loss account also has a defined structure. It shows revenues, costs, and expenses in a way that clearly leads to the net profit or loss. Standards ensure that similar items are grouped together. This makes the statements easier to read and understand. Consistent presentation across different companies also aids comparability. Let's look at some real-world examples of accounting standards. This will help you see how they work in practice. In India, the Institute of Chartered Accountants of India, or ICAI, issues accounting standards known as AS. One important standard is AS1, titled Disclosure of Accounting Policies. This standard is fundamental. It requires companies to clearly state the significant accounting policies they have adopted in preparing their financial statements. For example, how does the company value its inventory? Or how does it calculate depreciation? These policies must be disclosed in one place. AS1 ensures that users understand the basis on which the financial figures are prepared. Different policies can lead to different results. So knowing the policies is vital for proper interpretation. If a company changes a significant accounting policy, AS1 also requires disclosure of this change. The impact of the change on the financial statements must also be shown. This prevents companies from quietly changing policies to manipulate profits. It promotes transparency and consistency. So, who creates these important accounting standards? They are developed by dedicated organizations known as standard-setting bodies. These bodies are typically composed of accounting professionals, academics, business leaders, and government representatives. Their main job is to develop and issue high-quality accounting standards. They also work to update existing standards as business practices evolve. These bodies conduct extensive research and consultations before issuing a new standard. This ensures the standards are practical and relevant. In India, the primary standard-setting body is the Institute of Chartered Accountants of India, or ICAI. The ICAI, through its Accounting Standards Board, or ASB, formulates accounting standards, or AS. These standards are then prescribed by the central government for companies. The ICAI plays a crucial role in maintaining the quality of financial reporting in India. We have covered a lot about accounting standards today. Let's quickly recap the main points. Accounting standards are the essential rules and guidelines for financial reporting. They ensure that financial statements are consistent, comparable, and transparent. This is vital for building trust among users like investors and lenders. We learned that standards are needed to prevent confusion and potential manipulation. They provide a common language for businesses everywhere. This allows for fair comparison and informed decision-making. The core of accounting standards involves 4 key aspects. Recognition tells us when to record an item. Measurement tells us at what value to record it. Presentation dictates how information is shown in financial statements, and disclosure requires companies to provide additional necessary information in the notes. We looked at examples like AS1, Disclosure of Accounting Policies, AS10, Property, Plant and Equipment, and the International IFRS 15, Revenue from Contracts with Customers. These examples show how standards apply in real business situations. We also discussed the important role of standard-setting bodies. In India, the ICAI sets accounting standards, or AS. Globally, the IASB issues International Financial Reporting Standards, or IFRS. These organizations work hard to create and maintain high-quality standards. Their efforts contribute to a more stable and trustworthy global financial environment.